Good afternoon, everybody. Thanks for coming to the webinar. We're going to give it just one more minute and then we will kick things off. But thanks for joining, everybody.
Yeah, for everyone who is in the meeting room, it looks like we have some more participants joining. As we go today, we are going to open it up for Q&A. Try to keep this organized into sections. So if you hear a prompt that you would like to learn more about after the presenter has finished up, we'll read off some questions. Waiting for a few more people to join, so we'll give everybody another minute or so.
All right, let's kick off, John.
Perfect. Well, welcome everybody. Good afternoon, and thanks for joining us. My name's John Gavin, Senior Vice President here at PCM Encore. We're excited that y'all had a chance to join us today. We've seen the markets start this year, the S&P 500 at all-time highs, and interest rates are really beginning to shift. And so we have a lot of clients reaching out as it relates to the markets, pondering what strategy might make sense for them. Today's session, we are really focused on talking about durable after-tax outcomes for clients who have concentrated stock positions, deferred compensation plans, or complex 401k structures. This is really geared towards tech employees and executives. But if you're on the call, you're not in the tech community, I'm sure you'll find value in this, even more broadly to your 401k plan. Let me introduce everybody on the call. Today, we're joined by our CEO, Mike Paulus, Joe Hendrickson, who leads our PCM tax. And lastly, we have Zane Vercher, a fellow Senior Vice President here, who brings over a decade of investment management and financial planning. Zane, I'm going to turn things over to you if you want to kick things off for us.
Thank you, John. I said at the beginning of the call, we're going to try to keep this structured. We have a few sections that we're going to move through. We're going to start with 401k and workplace compensation. Then we'll move to deferred compensation. That would be things like employee stock purchase plans, restricted stock units. Many of our tech employees get stock awards as part of their compensation packages. At the end of each section, we'll have time for some audience Q&A. So if you haven't located it on your screen yet, you're welcome to drop questions into the question box. Why don't we start with a strong foundation, workplace benefits that anchor your net worth? Mike, you've spent a lot of time in tech, working with executives, building businesses in Silicon Valley. Can you set the stage for us? Tell us what you think about how technology fits into our investment strategies.
Yeah, no, it's a great question. And this is a subject near and dear to my heart, being down at Stanford and really spending my whole life between Silicon Valley and Bellevue in Washington, really tech hotbeds, and then myself both started a couple of tech companies. And actually my first employee here was our CTO, who was longtime Microsoft exec, and then had worked to start a couple of companies with me. So this is a topic that I'm passionate about. And something at PCM Encore is we really specialize in the financial realities of tech employees and not just generic wealth management. Tech compensation creates a different set of problems. We mentioned them: equity concentration, liquidity events, tax complexity. And oftentimes you're in a more volatile stock to begin with. A lot of advisors look at tech employees really just like a standard high income professional, where it's really a lot more nuanced. So let's talk about kind of taking a step back into what's going on in the tech world. I think the first narrative that is missed a little bit, there's been this thought of the Make 7 and outperformance by big tech companies. That really, it's been more variable over the past even 5 years. So if you, between Microsoft, Amazon, Meta, and Apple, Microsoft and Amazon have both underperformed just the S&P 500 index over the past 5 years. In the case of Amazon, the return's been less than half of the index. So I think, while there's always the NVIDIAs and there's always someone that's up, in aggregate, there has been a lot of individual company risk within big stocks. And every one of those names, every one of those names to date has underperformed the S&P 500. So I think that the first piece is just the value of diversification. I think if you look at the markets broadly right now, the US market feels expensive. The 1.12% yield that you're getting on the S&P has been lower prior to the 2000 tech bubble. So while we're not, saying have no equities in the portfolio, we do have caution, and we're looking to diversify away within the portfolio. And I think you look at sentiment right now, and you have this really interesting dichotomy where simultaneously AI has, sank a lot of industries, and this risk of AI adoption is bringing folks down. But then simultaneously, AI spending is starting to weigh down the big tech companies. So we're in this really interesting place. And I think the best way to think about it is people recognize that AI will be destructive, but I don't think people are sure how good a business it'll be. If you look at companies like Facebook and Google, you're in a 97% margin advertising business. There is no better business that exists. Microsoft has a 80+% margin monopoly business in software. If you look at the spending in AI, it's clear those aren't going to be the margins, but it's really unclear whether there's going to be a great business model that comes out the other side. So I think we go into this with a period of uncertainty. Now, every name I mentioned are a core part of our client portfolios. So certainly that, I think you don't run away from AI. You don't run away from big tech. I think that will continue to be a driver of the economy, but you want that to be the appropriate, part of a portfolio. And I think anytime, more than 5% of your portfolios in a single name, there is an opportunity simply through diversification to either get the same or higher returns while taking less overall risk.
You mentioned diversification there, Mike. Sizing those opportunities appropriately is a big part of what our investment policy committee does. Appreciate that. Since we're talking about 401k plans, a topic that comes up a lot is mega backdoor Roth conversions. So a question for you, Joe. We see a lot of clients asking about this. What do you see as the biggest tax landmine when people try to go at this themselves without professional oversight?
Yeah, I think it's a fantastic question. So we know mega backdoor Roths are a very powerful tool. We recommend a lot. It's an ability for us to move a substantial amount of funds into a Roth account above and beyond, the standard employee contribution limits. But it involves a lot of moving parts. So as you note, it's easy to step on a landmine if our timing's not perfect with conversions and being mindful of segregating accounts from there. I'd say really the biggest risk we see isn't actually the contribution itself, but it's the accrual of taxable earnings. There's a timing trap. So the moment you move those after-tax dollars into a 401 account, they start generating earnings. And if those funds sit for any period of time, weeks, months before you execute those in-plan conversions to the Roth account, they become taxable. And without really an automated or immediate conversion process, we're creating a rolling tax liability that's truly undermining what our primary goal of the strategy is. And I'd say on the other hand, we have this common illusion of an employer match and how that relates to the Roth. And it's a common misconception that if you go all in on a Roth strategy because you're a high earner, your entire account is growing tax-free. However, in reality, employer matches are almost always pre-tax, so traditional dollars. So even if our contributions are to a Roth, those matching dollars are growing in a distinct taxable bucket. And if we're not planning accordingly for that distinction, we might be surprised with a large tax liability or bill down the road in our retirement years. I'd say probably the most important and most dangerous landmine though is when people try to move funds without quarantining after-tax principal from employer's pre-tax match. We trip up what's called kind of the pro rata rule. And this is really, at its simplest form, the IRS not allowing us to cherry pick pre-tax and post-tax or after-tax dollars. If your plan's not segmented correctly, the pro rata rule kicks in. Really, instead of moving 100% of the tax-free principal like we wanted to, we're moving a blend of pre-tax and after-tax dollars, meaning that the IRS is taking a cut of every dollar we move, whether we intended to or not. Really, this gets even more complicated and messy when we have individuals who change employers or they roll their 401k into a rollover traditional IRA. I'd say the biggest fix, something we see often, what we recommend is really it's about infrastructure. Let's make sure the plan is set up to convert those after-tax contributions to Roth immediately. And let's maintain a clear and distinct wall between after-tax principal and the employer's pre-tax match. Really, let's clear that path before we hit the convert button, so to speak.
Really good stuff, Joe. And I want to add, there's another layer of complexity with these self-directed brokerage options and PCRA accounts that we see for a lot of the tech executives and tech employees. These plans are great. They have great options. A lot of them have the mega backdoor Roth conversion function with the in-plan automatic conversion on contribution. Joe, can you talk to us really quickly about the changes that have been made in 2026 to the contribution limits?
Yeah, so I think it's a fantastic question. Going back to, we talked on employer limits from there. So really we see an increase in employer pre-tax or Roth dollars moving up to this $24,500 limit to those employer sponsored plans. However, now we have a total employer and employee amount that increases to $72,000, which gives us that capability. Again, the employer sponsored $24,500, employer match portion, plus that excess remaining, really allowing us to put a total $72,000 into a 401k, noting that's separate from traditional Roth IRA account contribution amounts, $8,000 from there. So really a lot of opportunity for us to move money strategically into those sponsored plans.
Really good stuff. I'll add one note: Secure 2.0 put into effect in 2026, the super catch-up contribution. So for our clients age 60 to 63, you can sock another $11,250 a year into these plans. It just opens it up so that you can save aggressively right before you retire. So thank you for that, Joe. All right, let's move into the next section. If anybody has any questions, you're welcome to drop those, and I'll revisit the question list here in a moment. Why don't we talk for a minute about our ESPP plans, deferred compensation plans, that type of thing? John, I want to direct this one at you. Unlike a 401k plan, the DCP, the deferred compensation plan, is an unsecured obligation of the company. So in 2026, in this environment, how should an employee factor credit risk into their deferral percentage, as well as how far out they want to defer their compensation?
Yeah, it's a great question, and you said it very well there, Zane. It's, the deferred compensation plan is really an unsecured promise from the employer, and then I think that needs to be considered seriously, as you're really taking on company risk when you're doing this. And so it really means that we should be not only factoring in the financial strength of the company you work for, but also how much wealth you have tied to the employer. So if we're contributing to the plan, and now we're getting maybe some restricted stock units and then also deferred compensation, we're really concentrated to that employer. Not to say that there's anything wrong with some of the big tech companies, but concentration is something we would prefer to avoid and utilize diversification. I think if a large portion of your income is really dependent or moving towards that company, it's something that, in the planning process with our clients, we tend to try to rethink. We want to take advantage of the deferral. Deferral is a very powerful tool, but it does need to be sized appropriately.
Thank you for that, John. Appropriate sizing, that's the key. A question for you, Joe, to piggyback on that. A lot of our clients, they may live in no state income tax states like Washington. If I worked in Washington, but I plan to retire in California, how does the deferred compensation installment payment change my take-home pay?
Yeah, so this move from a low or no income tax state to maybe a higher income tax state like California, it's something we see quite frequently. I think really illustrates this idea that set it and forget it can be a costly mistake from a tax perspective, especially when it relates to deferred compensation. So without going too far into the details, I'd say federal law gives a very unique protection for retirees, specifically, D types like this that we're talking about, protection from former state taxation. This only triggers though if, they're structured as a series of substantially equal payments over at least 10 years or, someone's life expectancy. All I'd say is it creates this unique timing gap with our deferral and what the payout strategy is. Let's put it in an example of a 9 versus 10-year trap, so to speak. We have a $600,000 DCP. If you take that money over 9 years or less, you're a Washington resident, you've moved to California, which as we know, it can hit 13.3%. All that income is sourced to where you earned it. So Washington in this case, which currently as it stands, no income tax state, so you pay $0 state tax. If we extend that just one more year, say we were being strategic and saying you're high income earner, we want to spread this over a multitude of periods of time. By extending just one more year, we're now sourcing that income to your state of residence, which is now California. So as compared to going from zero income tax state, imagine we're at a 13.3% top marginal tax rate. You could be paying $80,000 on the high end just from that move alone. And by not actively reviewing your DCP elections, knowing they're rigid, they're hard to change, there's some deferral requirements from there on what the extension is. Really, I'd say the bottom line here is that difference between the 9 and 10-year payout. It's not just timing implications. It's potentially massive swing in state tax liability. So we need to be regularly checking in on our elections and reviewing and saying if there's a move that can come up at any point in time, we need to think through and navigate what that looks like. And if there's any changes in state level taxation, that's also going to change our planning and what our considerations for the DCP plan are.
Speaking of timing, Joe, we have a question from our participants, and I'm going to put you on the spot. What happens to my DCP balance if I'm part of a layoff or if I leave the company unexpectedly?
Yeah, fantastic question. Obviously, timely question as we all think about overarching markets, AI disruptions, what this looks like. So I'd say, one, you have the company risk, but it doesn't mean your balance just disappears. It, however, triggers what we call a separation from service. And really, unlike 401ks, DCP funds can't be rolled over. So your departure automatically activates that payout election. So we talked about rigidity with the elections, how that needs to be, 12 months in the future and what that looks like. But all that's saying that if you previously elected a lump sum or shorter period of time for your DCP payout, that entire balance can hit your income all at once. So if we're thinking about a year where we're, maybe laid off midway through the year, we received severance, there was maybe a Q1 bonus, plus the DCP payout, this can push us into really high federal state tax brackets, creating a massive and unexpected tax bill, especially if we, are laid off or looking for a new, employment, which is why I'd say we emphasize reviewing those elections, going back to that annual review, making sure that once we leave, whether it's intentional or not, we're locking in tax consequences and being mindful and proactive of the planning opportunities there.
Love that, Joe. Thank you for that. Let's move into a situation that we see really commonly with our tech employees, and that is stock awards, restricted stock units, vesting schedules, that type of thing. Question for you, John. We get questions often around the immediate sale versus hold debate. With 10 to 15% discounts, as we often see, is it wiser to just take the guaranteed discount and diversify immediately, or hold on to the position and let it become a concentrated stock in the portfolio?
It's a great question, and I'll try not to say it depends, because it does always depend on the individual situation. But I would say there's a couple ways to think about this. The first is, if we're getting a 10 to 15% discount on a stock, selling it immediately does lock in that return, right? And in a way, you're reducing the exposure to the concentration, right? The company that you work for, and so that on one side of things eliminates some risk. Now, the second thing we want to look at is overall tax situation when we're locking that in. What does that do to the overall client's tax situation? Some of our clients choose to hold and they don't sell. They feel confident in the company. They want to continue to benefit from the long-term growth if they're in a more growth environment, and they want to lock that in. So, when you can lock in a 10 to 15% a gain, it makes sense, right? Most of the time. But again, we would want to walk through the individual's tax situation to understand that and their comfortability with holding if they wanted to do the latter of the two.
Walking through those scenarios is something you're familiar with, Joe. So a question for you, for restricted stock units, the default 22% federal withholding is a trap for our clients that maybe in the 37% tax bracket. How do you handle that gap during the tax year?
Yeah, so it's a great call out that is often not really evaluated until we hit April timing. So that tax gap, if we're withholding at 22% as a default for supplemental wages, RSUs are included in that definition. There could be a 10 to 15%, depending on where you're in 32, 35, 37% bracket. Really, to compound on this is to say, if we're not paying as you go, IRS states often assess underpayment penalties, which is why it's really important to be proactive and look through the windshield, so to speak. Plan for the year ahead. So run periodic projections of total anticipated income, including employment, interest, dividends, capital gains, any other realization events, and then layer in potential deduction opportunities, whether there's any more advanced planning to reduce the offset. Really what we do once we identify that there's a potential gap, we want to bridge it and avoid that underpayment exposure. So once we go through that analysis, we typically will recommend flavor of options. One being increase your W-4 withholdings on a regular salary. Take out more per paycheck in anticipation of those RSU vest being at 22%. Second, we can look at voluntarily increasing those withholdings on supplemental income. So as our RSUs vest, maybe worth withholding more than the standard default rate there. And lastly, we can look at making quarterly estimated tax payments, really paying as you go. The goal here, I would say, is to hit minimum withholding requirements, both federal, state level. So we're not writing a massive check that may include penalties and interest come April filing time, but also being mindful not to over withhold too much. So we're not providing, the government an interest-free loan, so to speak, keeping more cash in your pockets so you can be able to spend and maybe reinvest and deploy as you desire.
Thank you, Joe. Here's a fun one for you, Mike. We do see situations related to the question we were asking John earlier about the decision to sell down a concentrated stock position or just hold on. We do see plenty of our clients who they choose to hold. So they could accumulate tremendous amounts of money in their employer stock. So for someone who's sitting on maybe $10 million in Microsoft or some other tech stock, when do you look at more advanced tools like exchange funds, for example? I think you're on mute, Mike.
I'd first say the number can be a lot lower than 10 million. I think, relative to your net worth, again, I think if you have 5%, certainly more than 10% of your net worth in a single name, you have a concentrated stock risk. And oftentimes we see folks coming to the door with 50% or 80% of their net worth. And first of all, you celebrate it, right? You made the right bet, you found the right employer, and that wealth generation, is remarkable. But often folks feel trapped. On one hand, they know that they're concentrated. They want to diversify. On the other hand, at a minimum, they're facing a 25% tax bill. It could be 40% or more, depending on the state and the situation. And really, we're focused on capital gains from this perspective. So what are the tools? How do we get diversification? Well, minimizing taxes. The first tool in the toolkit is an exchange fund. And what we can do for an investor is they can contribute their concentrated stock into a pooled vehicle in exchange for an interest in a more diversified portfolio. And then after a set number of years, they actually get a diversified pool of stock distributed to them. And what this allows you to do is get diversification, but do so without actually having to sell the stock and pay that significant tax hit. So for the right person, it's a great tool. There's liquidity issues, there's fees that come with it, there's eligibility requirements, but it's a very elegant solution when it comes together. A lot of the work we do is working with the leading funds to make sure that we can get our clients placement there, and we're constantly looking at where that's available. So for the right person, exchange funds can be really effective. The next piece that's almost right for anyone is direct indexing. And, for us in our equity portfolios, rather than own an ETF, we tend to directly index clients. So they own a basket of stocks that mirrors the S&P 500 performance. What you're allowed to do when you directly own stocks is, every day there's winners and losers in the stock market. By selling off those losers, we can, while still tracking the stock market, we can generate significant tax losses. And this can equate to an alpha a couple of % a year. And how does this relate to concentrated stock? There's really a couple of ways. The first is if you already have some stock market exposure, by moving it into direct indexing, we're able to accrue these capital losses, these carry forward capital losses, so that when you do sell that concentrated stock, we've already got capital losses to offset it against. So that's really the proactive approach. The next piece is when you do sell, let's just say you sold some stock today and realized a capital gain, we now have, another 10 months of the year in the current tax year to offset those. So by putting them into a direct indexed account, or we can even put leverage on this and create more aggressive strategies, you're in a position where, even if you have to pay an estimate at the start of the year, we might be able to get a nice refund towards the end of the year. And then I look at it, it works really well with folks with repeated liquidity. So they have some stock now, they have additional tranches later, or maybe, a lot of times for folks, it doesn't have to be all or nothing. It's not, do I blow out all of my Microsoft stock? Maybe I take a third, maybe I take half, right? I think there's a lot of nuance there. And if you can take that first tranche of liquidity, put it into direct indexing, start accruing those losses, then any future capital gains, we have a nice solution and some losses against. So it's great both for folks that have an immediate liquidity need and folks that say, look, someday I'm going to sell this stock or my home or whatever it is, and let's get ahead of it and have those capital losses. And, finally, there's circumstances where it actually benefits us to have capital gains. One of the biggest tax breaks that came out of the Big Beautiful Bill last year was opportunities on real estate. And if you have a qualified capital gains, and in most cases, our tech employees' capital gains would be considered qualified, you have 6 months to invest it in opportunities on real estate. For us, that usually means apartment building, for example, in Seattle or Oregon or down in California. And what you're able to do there is first defer the tax. And in 2027, that deferral will go to 5 years. So you don't have to pay that tax for 5 years. It does a lot of powerful things. One, that there's the value to that. We can take other proceeds into direct indexing and actually harvest losses. So by the time that tax is due, we've actually eliminated it. You also get a step up in basis, so the tax is reduced. And then if you hold that property for 10 years, and we're getting good cash flow the whole time right off these apartments, for example, you pay no capital gains. If you pair that with another interesting element of the Big Beautiful Bill, which is accelerated depreciation, you have this remarkable opportunity where, let's just say you invest $100,000 in an opportunity zone. With depreciation, we can often give our investors a loss of $130,000. So that's actually more than you invest. We can then hold that, and at 10 years, we neither have to pay capital gains, nor do we have to recapture any of that depreciation. So, I think there's a lot of good ways to both eliminate the gain, and then there's some really interesting opportunities if we have that gain where we can use it to our advantage. And then I think the other piece that people miss with diversification is, people look at the concentrated stock today. You should also look at your employer and your income. It's a bit of a bond. If you work for Google, you also, in a way, have a bond and annuity attached to Google. And you also have a lot of stock that's coming up in a vested way. So, in addition to the sort of the concentrated stock, you likely, between it also paying your employer and your future stock grants, in your whole financial life, may even have more concentration towards a single company.
Thank you for that, Mike. You mentioned 3 really big ones there: qualified opportunity zone investments, exchange funds, tax loss harvesting custom index funds. Combining all of those 3 together is really, really powerful. And we don't need to use every single one. Every situation is unique. I want to pivot into our, kind of a peek into client life. I'm going to pull something up on the screen that we use for our clients. This is a tool that our clients do get access to. We talked about a lot of complex topics today, and maybe every single one of them isn't relevant to you. But this is the tool that we use to keep everything straight. This is your dashboard. John, Gavin, and I, we spend a lot of time in this tool. So for the next maybe 5 or 10 minutes, just going to take you on a really quick tour. What we have on the screen here is a sample client. We've got Jerry and Rhonda Stein. I'm gonna tell you just a little bit about them. They live in California, high state income tax, a lot of special capital gains tax issues that we need to be aware of if they're going to retire in California. They're in their late 50s. Jerry is a Microsoft employee. So Jerry has been getting stock awards for a long time. He's elected to retain that Microsoft stock. It's done very well. So he's got a lot of company stock, highly appreciated. And you see on their chart of accounts, they've got a lot of different things going on. They've got tax deferred money. They've got Roth dollars. They have annuities. What's not shown on this chart of accounts, but is included in their net worth bubble up here, is they also own real estate. So Mike was talking a moment ago about depreciation. How can that depreciation be used to offset their investment income, potentially some of their active income under some circumstances? But John, let's talk a little bit about this, because I know you and I spend a lot of time in this. Let's put you in the seat of a client. What kind of questions might you ask if you were in the client's shoes?
I think where we should start saying, why don't we, if you could walk through just an overview at a very high level of kind of the day in the life of the portal, kind of explain this a little bit, and then we can kind of move a little bit deeper as we go through the rest of the demo. I think it would be good just to set expectations on the high end of what the portal can really do.
I like that. This is a really powerful tool. Some of my clients, when I pull this up, it reminds them of Mint, which is no longer around. Tools like Quicken, it has some similarities to those, except this isn't just a net worth calculator. We're not just trying to keep track of where everything is. That's valuable, but actually this is a projection tool. We're looking out into the future, and we use this tool to stress test the portfolio. What if market conditions aren't what we anticipated? What if we see a really big downturn the year following retirement? 2022, we saw a lot of volatility for clients who are retiring around that time. That can be scary. So have we planned for that possibility in advance? That's what this tool is all about. So I like to think about this as your just financial hub, where you're coming to check where is everything. Everything's integrated, so we're getting real-time updates on your holdings. You can see on here the chart of accounts below. This is what I was referring to. This section is linked to your actual accounts. Now, those could be 401ks. They could be at different custodians, Fidelity, Schwab, Morgan Stanley, wherever. An important note, I said it before, I'll say it again. You do have access to this tool. So You don't have to log in here if you don't want to, but this is where our planning team lives. So Joe, who's on the call, who leads PCM Tax, our private wealth advisor team, certified financial planners, we are in here working actively. You can come and observe. You can come in and do some of your own analysis and stress testing if you like. But this is how we collaborate with clients. We try to meet with our clients maybe 2 to 4 times a year, depending on the complexity of their plan. And then, between those scheduled meetings, if you have a life event, if, maybe you change employers, move to another place, you're going to try to roll your 401k plan into the new 401k system, or maybe you have a child, or maybe something like a death in the family. There's a lot of different things that we need to jump on a call and we need to have a conversation and we need to adjust the plan. 2 to 4 times a year is our routine, but in the interim, if you have questions, give us a call. We log in together and make adjustments.
Zane, let's dive in. I think at this point, if I'm a client, I'm asking, well, what can this tool do for me? Can you walk through maybe some of the different stress testing that we can do given the client situation?
Definitely. Yeah, this is a strong foundation. This is just balance sheet, whereas everything, but let's try to look into the future. I don't have a crystal ball, but I can do a lot of stress testing around different eventualities. What if we have disability expenses later in life? Or what if we want to explore estate planning options for a client with an asset size like this? Depending on the state they live in, especially, they may run into estate planning issues. What you see on this screen is we've moved past the balance sheet, and now we're going to start to look at some of the scenario testing that we've built. What you see here is this is a Microsoft employee. So one of the topics that Mike talked about earlier was the exchange fund and tax loss harvesting custom index solution to try to unpack that position gradually through time. Another one that we talked about earlier, mega backdoor Roth conversions. If we use the upper limit, and as Joe pointed out, as long as we're making sure to click all the right buttons and keep things neat and clean, what kind of an impact does that have over the life of the plan? I am not going to take the time to click into every one of these, but you can see there's a lot of different options here. Credit shelter trusts, donor advised funds are very attractive for our clients with concentrated stock. They're looking for tax benefits. I'll click into one of these just to give you a view. Notice we've got 3 different buttons here for our clients. Sometimes I do see them use Goal Planner. You might come in and say, hey, I want to fund my child's education. Well, let's go in and build a goal then. And then we can reverse engineer what kind of saving do we need to be doing to hit that goal at a particular time on the timeline. Decision Center is one of my favorite tools. I've been using this tool for a long time. This is a 2-pane screen. On the left side, you see toggles. These are custom toggles that our team has designed for the client to test different circumstances. Over on the right side of the screen, you see lifetime portfolio value. There's a lot going on under the surface. We've got investment assumptions. We've got inflation. There's a lot of noise and wind along the way. So this is a very simple expression, but there's a lot going on under the hood.
Zane, can you walk through the income side of things? I think when I'm meeting with clients, a lot of time they want to see where income's coming from, how income's going to be distributed, maybe even a look into the tax side of things. I think this tool does a great job of illustrating that as well.
Agree. Yes. Let's talk about income a bit. Notice before I move on into that report, I've got a couple of toggles, just one that I'll toggle on just to demonstrate the tool. We talked about stage diversification into a tax loss harvesting custom index fund earlier in the call. What kind of an impact might that have? Right now, we're just in, this is the vanilla plan. You could think about this like, if I do nothing, this is how things are going to go. If we decided, hey, we see an opportunity with harvested losses to unpack this position, I'm going to toggle this on, and what you'll see is over on the right side of the screen, we're going to see some effect. The green bars that you see, those represent value gained as a result of the change that we've made. So I won't jump into the detail. If you're interested in knowing more about this, set up some time to talk to us. But what's happening here is we are using harvested losses to offset gains and unpacking that Microsoft position through time. So we're really looking at tax savings. It doesn't look like a ton in the near term. Admittedly, these are really big numbers. So, a $500,000 swing by the time this client is in their mid to late 60s is significant. But check this out. Value gained over the life of the plan, $7.6 million. The way this is calculated is we're looking at the last year, second death year, assuming one of the pair lives to be 90 years old. We've got, instead of $22 million liquid, we've got a little over $29 million liquid. That's a long time horizon. Some of my clients tell me they want their last check to bounce. They don't want to die on a mountain of gold. So what we might advise a client on is, hey, how can we take advantage of this in the near term? What if I want to gift to children or something in the near term? So I can run scenarios in tandem. This allows us to build an optimal strategy. We're not just looking at one thing alone. We've got Social Security decisions to make. We've got decisions around Roth conversions post-retirement. But to answer your question, John, about income, I like to take people into this report section. I've got a handful of my favorites. Your favorites might differ, but estate transfer is a really popular one. Income tax, very popular, an area that Joe and I spend a lot of time with clients. I'm going to click into cash flow just to show what does the withdrawal plan look like. I'm going to select that scenario that I showed before about the Microsoft Exchange Fund and Tax Loss Harvesting Custom Index. This is really the same thing that we were looking at before. Over on the upper right-hand quadrant of the screen now, you see just lifetime portfolio value. Over on the left side, you see inflows and outflows with a detail below. I'm not going to go through every cell today. Would love to, if anybody wants to set up some time to talk to us, we'll build you in this tool so that we can show you your own numbers. But for John's question about withdrawals, deciding on the most tax efficient withdrawal schedule, it has really, really big impacts over the life of the plan, especially on a portfolio this size. It can mean the difference in millions of dollars. And we see that all the time. So this breaks the portfolio down into the accounts. So, we see the company stock, we see some core cash, we see whole life policies, joint accounts with money market funds. This is the order of withdrawals, the most tax efficient order, fully customizable. We can change it as needed. But you can see over on the right side, these withdrawal percentages for this particular client, very healthy. A lot of our clients have heard of the 4% rule. Try not to take more than 4% of your total portfolio value in a year. This client, well under that. So this is very healthy.
That's great, Zane. If we could touch on just the tax, maybe just give a snapshot of the tax view. I think that might be helpful. And then that might conclude the demo side of things today.
I like that. Yeah, let's look at the income tax side. This is going to be state dependent. And keep in mind, if we're talking about concentrated stock, this view will change based on our realization mode. So if we're going to be harvesting losses and applying those losses to gains that we'll realize in the future, that's one of the levers that we can pull to make this look better. Right now, we're just in standard mode, but gross total income, regular federal income tax, we have a capital gains tax setting built automatically on this one. Effective income tax rate for this client is very high. Is there something that can be done to reduce that is the question. The answer is a resounding yes. I'm sure Joe would like to do a consultation with you to find ways to save money on taxes. Good. Don't want to bury our attendance with too much information. This is a powerful tool. It's very complicated. We spend a lot of time on it, but remember that you have access to it as a client. You can log in here. You don't have all the same abilities that we will have on the advisor side, but a lot of my tech and engineer clients just rave about this tool. So why don't we start to wrap up? We're getting close to time. Thank you all for joining us. We really appreciate your attention. If any of you have any questions about what you've seen today, John, Gavin, and myself are both available. We'd love to hear from you. We're going to be sending out a recording of this to folks who signed up but might not have been able to participate during the live session. So feel free to respond to that email. We'll drop our contact information there. Reach out to us if you have any questions that we can help with. Thanks, everyone. Have a good one.